Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. Yet again this week, and for quite a while now, prices have been hitting and utilizing the bright red trend line formed at the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently at 848. Now, as I've said repeatedly in my commentaries, the market has occasionally staged rallies up to the 50% Fibonacci line of the August 2020 to May 2021 move at 900. But these rallies have stalled, and the market has instead expanded the downside. As a result, the declines in April constructed a monthly key reversal down, and very nearly the same for the month of May, but instead choosing to make a lesser outside month. These moves down and then back up created a diamond pattern type of sorts. But for the moment it seems it might be useful, so I have actually outlined it in bright green on my daily chart. The reason why it's specially outlined is that last Friday the market broke up and out of this pattern type. Thus, an initial primary target X for such a pattern would be in the 902 area, just over that 50% Fibonacci line, with a further harder to reach secondary target X1 up in the 946 level. Now, we've had a lot of resistances in the way before 900, and that may explain why we have seen prices start to stutter up here. One we already know about, and that's the red neckline, but we also have the 2014 high at 856, the 2013 high at 862, and especially following the three that have already eroded the immediate bullish incentive. They are the flatlining long moving average, 869, the 50% Fibonacci line of the September 2019 to May 2022 move at 881. And at the 900 area, specifically 902, we have the untested so far 50% Fibonacci line of the August 2020 to May 2021 move. We also have to acknowledge that we had a weekly key reversal up last week, supporting this move higher, which has had a follow-through higher this week. However, it will be interesting to see what the market does at the bright red neckline over the next few days. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat here continues to be a somewhat easier read with respect to what is going on and what the opportunities might be. In late January this year, prices punched up and out of the upper bear channel line of the first bear channel, constructed between October 2022 and March this year. Then 15 weeks ago, we had the first piece of bearish pressure coming from how the medium moving average, currently 855, capped the market in mid-February with a subsequent move lower. There was then some hesitation, which eventually became a bear flag over the turn of February into March. It was at this time that the market constructed a new second bear channel that after a period of time morphed into what we have seen in recent days, a descending, expanding wedge pattern, currently 729 to 874, originating from December last year, but really becoming evident from February this year. This is highlighted in dark blue on my daily chart. The upper trend line, currently 874, had been previously reinforced, sort of, by the declining medium moving average, which combined to help cap the market in very early April, then mid-April and mid-May. Last week we saw another attempt higher through the short medium moving average, currently 834, the medium moving average, the August 22 low at 862, the 2017 high at 868, and finally breaking up over and closing over the upper trend line, currently 874, of the descending expanding wedge pattern. However, rather than exploit this significant break higher, the market has chosen to sit and possibly recuperate from the strains it has recently undertaken, and perhaps not to immediately take on some stronger resistances, such as the overhead long moving average, currently at 898, that obviously capped this week's rise. I've been heavily tempted this week with this move up over the upper trend line to lay out potential topside targets for the pattern. However, I've chosen not to, simply because we are still too close to the trend line, despite being on the right side of it. We're still too close, and I have a concern that the market will only have a breach and not a break, and not a proper break, and prices may revert lower again. There is one more item I'd like to raise, and it was something I spoke about 2 weeks ago and raised ever since, and I quote, "The only other feature is a potential, and just that, a potential double bottom formed since April. It's way too early on that as anything more than an idea," end of quote. I added last week the following, and I quote, "It is still fairly early, or still early, sorry, but I can set out some idea of when this potential pattern could become a real thing. And that would be what prices do should they get to the 890 level. That would be where to look out for signs of this truly being a possible double bottom pattern. I've added one further point to this, looking closely also at the new flatlining long moving average that is just above. Actually, that's currently at 897. I'm sure this moving average will play a key part in any move up to the 890 area," end of quote. Thus, the long moving average has most certainly played a part in the action around 890, and it has, like the descending wedge pattern, prompted me to hold off giving an idea for any double bottom until we see action at these levels, specifically a stronger closing, move higher, over 890, and the long moving average.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.